Hi, I'm Peter Jones, Chartered Surveyor, author and property investor, and in this short series of videos we're looking at the different property strategies that are available for us to use. In the last video we looked at basic buy-to-let investing. In this video we're going to look at more sophisticated ways of doing buy-to-let. So we saw in the last video that the basic level of investing could be just buying a property without much thought, putting a tenant in and collecting the rent, and there are reasons why some investors may want to do that. After all, we're all very different. Not every investor wants to own a portfolio of 50 or 100 or 500 properties. They just want one or two, maybe to supplement their pension, maybe to supplement their income, and good enough is good enough, and they don't need to think about it at any great depth. But we can actually take it further than that. My favourite strategy in buy-to-let involves using BRR, buy, refurbish and refinance. Now BRR is not actually a specific buy-to-let strategy. It's a technique for buying properties, refurbishing, refinancing and recycling your money back out, which you can use with many of the strategies, buy-to-let included, but you could also use it, for example, with HMOs. You could use it with commercial property. But when you combine it with buy-to-let, it works really, really well. And this is how many successful buy-to-let investors have built large portfolios. Because the essence of BRR investing is to find a property where you can add value. Usually that's by way of a minor refurb, which is very easy. Maybe just putting in a new kitchen, a new bathroom, giving it a lick of paint, new carpets, maybe new windows if it needs it. There may be other incidental bits and pieces which arise as and when you start doing the refurb, which you might not have known about on day one, but that would be the essence of it. Kitchen, bathroom, redecoration, carpets, and by adding the value you can then refinance the property and hopefully recycle all or most of your money back out. In order to make the margin even greater, to make it even more likely that you'll get all or most of your money back out, you can buy the property slightly cheaply. So, for example, a property might be on the market for £80,000. Now, it's on at £80,000 because if it was in good condition and it had been refurbished, it might have been on the market. It might have been worth £100,000. But the price has been discounted to reflect the works. If you can buy that property for, say, £65,000 and spend, say, I don't know, £7,500 on the refurb, which actually is very doable. Sometimes when we talk about the figures, people are surprised that you can do a refurb so cheaply. A lot of it comes down to knowing how to find your contractors and tradesmen and how to buy the materials, but yes, it is possible to do it probably much more cheaply than you might have imagined if you're new to property. If you can spend, say, £7,500 on top of the £65,000, you will then end up with a property which is worth £100,000. If you can then get a 75% or even an 80% loan-to-value mortgage on that, you'll be able to get most, if not all, of your money back out again. And that's pretty much it. That's how BRR works. Now, it doesn't necessarily have to be a refurb. There may be other ways that you can add value. So again, a tweak on buy-to-let, particularly in areas where BRR is tough. BRR is tough in areas where properties have got a higher value, because the upper end of the range currently, as I record this video, is probably around about £150,000. Why? Because the banks have introduced what they call stress testing. If you're not quite sure what that means, then if you go to my website and you look at my blog, you'll see I've put some articles on there. But stress testing is where basically they come up with a notional interest rate and then multiply that by 125 or 130 or 145% over and above, and the rent has to be greater than that notional interest rate. It's not the interest you pay, by the way, it's just an interest rate which they use for calculating whether the property stacks up or not. And that's going to limit the top end of the market, the top value of property that you can actually buy using this strategy. It's probably about £150,000. So properties around the £100,000 mark, perfect. And it, as I say, it doesn't necessarily have to be the refurb route. You could do other things. And if you're buying in an area where property values are higher, or where you're going to struggle to do BRR, then maybe combining with something like title splitting, where perhaps you buy a house and turn it into 2 flats, or buy a house and turn it into 4 flats. If you do the figures, you'd obviously have to run the figures and make sure they stack, but maybe that would make this strategy work where you are. Otherwise, you may have to go and buy in a cheaper area where the figures do stack. But if you're not going to do a refurb, it could be that you do some kind of development, it could be doing a title split, it could be something as simple as turning a one-bedroom flat into a two-bedroom flat. How? Well, I know that investors in London and other big cities have done this by basically taking the kitchen out of the kitchen and putting it into the living room, so it becomes like an open plan living area, and turning the kitchen into an additional bedroom. Although the floor area of the property hasn't changed at all, because in this country we tend to calculate value by means of the number of bedrooms, then the value is probably going to value it as a two-bed and not as a one-bed, even though the size hasn't changed. So there's all these tweaks that we can actually make to property, which might make the whole BRR thing actually work better depending upon where you are. But at a basic level, a minor refurb and then refinancing, and yes, you can buy the property using a buy-to-let mortgage. A little bit tricky because buy-to-let lenders generally want properties to be what they call habitable. Now, by habitable, it doesn't mean pristine. It usually means that it's got a working bathroom and kitchen. Even if the kitchen and bathroom aren't up to scratch, some banks will accept it, some valuers will be okay with it, some banks won't accept it, some valuers won't be okay with it. So it's a little bit of a lottery, but that can work as well. Or another way of doing this can be to actually buy the property 100% for cash. If you borrow 100% of the funds, do the refurb and then refinance, the bank's probably going to be happy with that. Ironically, if you only borrow, the 25% deposit, say you're getting a 75% loan to value, and you borrow the 25% deposit, unless you're borrowing off a close relative like a grandparent or a parent, the banks probably won't be happy with that. Strange, isn't it? Happy if you borrow 100% of the money and then refinance later down the line, but they wouldn't be happy if you borrow 25% of the money and then take out a mortgage with them. Strange things, banks. But as a general rule, the BRR model is fantastic, and as I say, if once you get your head around it and once you understand it, you'll be able to see that it's very powerful because you can use it for other strategies as well. So, until the next video, here's to successful property investing.